This is the panel on uplisting in the current regulatory and business environment. And many of us hear the word uplisting used all the time. Now we're going to find out exactly what it means from our moderator, Joe Lucosky from Lucosky Brookman, a law firm on the East Coast, and his worthy panel. Joe, join us.
Good afternoon, everyone. Thank you for joining our panel, and I welcome you. Before we get started, I would like to just thank the organizers of this conference, Shelley and Lulu and Robert. They put on a fantastic event every year. We've been coming for a number of years and have enjoyed ourselves every single time, and we expect this year to be even better than the years past. So Shelley, Lulu, thank you. Robert. So as Shelley said, my name is Joseph Lucosky, and I'm the managing partner of a law firm on the East Coast located in New York and New Jersey. We're a corporate finance and securities boutique firm, and we've been practicing in the industry for a number of years. And in addition to what lawyers typically do as far as compliance and regulatory and financings and transactions, over the last few years, we've made a strong push to be very much involved in this uplist process, which we are going to talk about today. And we're going to get into a little bit more of the details, but before we do, I want to just introduce our panelists and let them introduce themselves to you, so at the end, you'll know who to speak to with questions and to reference the right person. So when Shelley asked us to put together this panel and really understand what we were going to talk about, we sort of worked together and thought, who can we put on this panel to make this worth your time? Most panels typically have a regulator, a Nasdaq person, maybe someone from FINRA. They talk a lot about legal jargon and legal regulations and legal qualifications, and we are going to get into some of that. But this panel is more about the nuts and bolts, sort of the anatomy of an uplist, the how-to, the day-to-day. You get up every day and, something else is coming at you in the uplist process. No uplist is easy. Some uplists are less hard. And we're going to talk about that process a lot more than we are about the legal regulations and some of the technical requirements. But to my left here is Peter Goldstein, who is the chairman and CEO of ExchangeListing.com. Peter has been a consultant, an investment banker, an investor. I think he's actually done a combat tour in compliance a long time ago. Very well experienced, and right now sort of leading the charge as one of the preeminent uplist consultants, soup to nuts, for the process. And I'll let him sort of talk a little bit about himself in a second. Immediately to his left is Luisa Ingargiola. Did I say that right? Yep. Luisa is, I was very excited to have Luisa on our panel because when we're thinking about the architecture of this, in my view, there's really nobody better to be on this panel than Luisa from a company standpoint. She has now been through this process, I think, 4 times? 4 times.
One with me, baby.
Yeah. And one with Michael. And Luisa, she served on boards of directors, audit committee chair, CFO, and she took her family company a long time ago, 10 years ago, from literally nothing, a blank check shell corporation, Form 10, for those of you who remember those, through a growth cycle to the Nasdaq, raising tons of capital, liquidity. So she is very well versed in sort of this process, and most recently as audit committee chair of a Nasdaq company. And immediately to her left is Michael Jacobs, head of investment banking at Benchmark Capital, who is very much active in this space. And I want to just say a little bit about activity. The people on this panel and some of the other people we see here in the audience are very active, doing deals, executing deals, closing deals. There's a very big difference in my mind, the people who get things done and the people who talk about getting things done. It's easy to lecture, it's easy to talk, it's hard to do. And this panel was hand-selected because of what they've done. So with that said, maybe Peter, you could start and just give a little introduction.
Great. Thanks for the great setup. Now I got to step into, being able to be a good panel member here and be able to give you a better description about the process. Exchange listing was really created as an advisory firm to work with OTC companies as well as private companies, but on the uplisting side, to work with OTC market companies that want to go to either Nasdaq or to NYSE. And the approach is really as a one-stop solution, coming from the standpoint of the officers and directors and shareholders and working with them. Majority of our compensation is taken in stock, some fees, but the stock really is based on milestones. And those milestones are working you from start to finish all the way through the listing. So exchange listing really for you to think about is a one-stop solution, working in conjunction with your attorneys, with your bankers, with your officers and directors, and guiding you through the process. I like to think of us as a quarterback for the process. As Joe said, there's nothing easy about uplisting. It requires a tremendous amount of focus, and our role is to help keep everybody focused to reach the milestone of listing.
Thank you. Luisa.
I mean, you gave a great introduction, but basically I've been the audit chair or CFO of several companies, have gone through the Nasdaq and the New York Stock Exchange uplist process multiple times. A lot of stress, a lot of late nights, and through the process I think I learned pretty well what works and what doesn't work. And in terms of how to handle corporate governance, how to handle the minimum requirements, how to build a relationship with your Nasdaq analyst, all of that I think I can bring to the table today. So I appreciate the invite. Thank you.
Thank you. Michael.
Welcome to the real financial professionals of Planet MicroCap, Las Vegas style. I'm Michael Jacobs. I'm the head equity capital markets at the Benchmark Company. I'm a glutton. I'm a 30-year veteran of the microcap investment banking space. Spent some time as entrepreneur, principal, and agent. Been at the Benchmark Company a couple of years. Benchmark is an institutional, research-driven banking firm, 30-year history, really started out only institutional sales, research, and trading, got on a bunch of covers with big firms for names we covered from a research perspective. Like 2 weeks ago, we were on the cover with JP Morgan Chase for a $240 million Reg Gay 144A for live person. That's not an area of the world that most of us make our living in. And kind of 6-8 years ago, Benchmark started building out traditional banking with John Bora, who ran Rodman for 20 years, joined Benchmark. I joined 2 years ago to put us on the cover of more deals, run books, et cetera. And notwithstanding the fact that uplisting transactions are my personal least favorite transaction out there, I think over the last 18 months done as many as anyone, done approximately 6. With a couple of people on this panel, Luisa is board member, Joe is company counsel, and my goal in speaking on this panel today is, I think, twofold, is give you some tools to make it easier to do this correctly, because it's just not an easy process from beginning to end. And then Joe has pushed me to give you some tools to be able to call bullshit on my contemporaries and peers when they're looking to do the wrong thing in terms of things like consulting fees and other stuff that we'll get to.
We had a very spirited breakfast meeting. Let's just put it at that. Thank you, Michael. So before we get into sort of the nitty-gritty, I just want to define, what is an uplist? What is the uplist process? Because I've spoken to some of the people here today and yesterday and this morning, and everyone has a different definition. Some people think it's uplisting from the pink sheets to the OTC. Some people think it's from a lower level of the OTC to a higher level. But what we're going to really focus on here today is really an OTC markets company that is looking to list on a senior exchange. So, and a lot of the same rules, I will say, for the private companies here apply similarly to you. So when we say uplist, we really do mean list on a senior exchange. That is our sort of definition, and that's what we're going to spend, all of our time today talking about. But private or traded on OTC, very similar. So that's sort of the definition. And before we get, again, just jump in, I just want to say, these transactions have become very popular recently. I would say over the last couple of years. They used to happen, I guess less frequently, but This is what I guess the markets have demanded. This is where the investors want to put their money. This is what they want to see as the markets have evolved. And there's a lot of benefits to, and we talked about this a little bit at breakfast, there's a lot of benefits to uplisting. And I promised Shelley we wouldn't be too complicated and too advanced. We would sort of take a step back for those of you who are just learning about this process. But the reason, and there's many, and please jump in, the reason many OTC companies want to uplist, let's say, to a senior exchange is because there's this belief that, you know, you get more, or you get more eyeballs, or things become easier. Life becomes easier on a senior exchange. Now, those of us in the profession would probably argue otherwise. Things sometimes get more complicated, but some of the ills of the OTC, and the OTC is great. There's, you know, we have tons of great clients in the OTC, and we love OTC markets, but again, focusing on the uplist, there's a lot of benefits, and we've talked about some of these: liquidity and governance and shareholder confidence, and perhaps easier to raise money, S3 eligibility. I don't know if there's any others that sort of ring a bell.
Broader potential investors. There's a huge group of mostly institutional investors that just won't invest in a company listed OTC. So you take the institutions on one side, and Shelley mentioned earlier the regulatory pathway. There are a large number of retail brokerage firms whose clearing firm won't let them hold OTC. So you're squeezed in both. And if you're going to be a public company and invest the time, effort, and money in being public, yeah, you got to get off the OTC.
Clearing is a whole other panel discussion that we can get into. But it is easier to clear generally as a Nasdaq company, even if you have a you don't meet the minimum stock price requirements, or you slip off and get a grace period. But so with that said, and now that we've set the stage of what is an uplist, we've talked about a little bit of the benefits and why people are rushing to this sort of uplist process. We're going to set this into sort of three pieces, and I just want to give you the overall architecture. Peter is going to speak for a few minutes on the overall process and the ground game of an uplist. You know, what he does, more specifically, what we all try to do to get a company from the OTC to the Nasdaq. And then Luisa is going to focus next on some of the minimum requirements, but with a little different twist, more of some of the advice, thoughts, tips, tricks, as opposed to just the legal regs. And then we saved arguably the best for last. We'll spend the most time and have the most fun with Mr. Jacobs. Everybody wants to hear on how do you raise money in connection with an uplist, and what are some of the pitfalls and pros and cons, and how do we beat the bankers down on their fees and unaccountable expenses. We'll get there. So with that, Peter, why don't you walk us through the ground game of an uplist transaction, more specifically, some of the bumps in the road that we've all experienced in these wonderful yet frustrating transactions.
One of the challenges, I think, is that there are many bumps in the road when you go through this process. Obviously, you're hearing that there are a lot of moving parts. And so while this is doable, there we go, it's very doable. And quite honestly, I think many OTC companies are closer to listing on a senior exchange than they might realize. So part of what we look at when we first talk to a company, and where I think you'd want to consider if you're looking at listing, is just a situational analysis. You know, where are you as a company, taking a snapshot of the things that are important for listing? And that is the basic ground game to start with. It is the lead into developing a strategy and a blueprint and an action plan on going from the OTC markets onto, a senior exchange. So the things that most people want to start with and look at are the quantitative components. What's your shareholder equity? How many shareholders will you have as a round lot number of shareholders after a reverse? What's your stock price? Those are all critical components. And then there's the qualitative, which I think people don't realize how important they are. The qualitative components, which is really an aspect of your governance, including your board and the committees. And it's a very important part of the review process. So those components are what we look at first. One of the things we do when we offer to the OTC companies that Shelley has invited and brought here to the conference is to do a free situational analysis. It's really to determine what your pathway is on that route. And for some companies, it might be much shorter. For some companies, there's more of a maturation process and more challenges. more of those obstacles, if you will, along the way.
Yeah, and Peter, who should do that analysis? We've heard over the months and years, I've talked to my accountant. My bookkeeper told me we qualify. My uncle thinks we should uplist. I mean, who should really do that analysis? Is it the lawyer? Is it you as the quarterback? Is it a board member? I mean, tell us a little bit about that, because that really is the first step. Without that, there's no foundation.
Agreed. I think the most important thing is that it's a qualified professional, right? So that could, in this case, be Joe. It could be your banker. It could be a board member, if they understand what the listing requirements are and are able to really take, a deep look from an objective perspective about the company, right? So, those professionals who understand this are why we're here, right? To be able to give you that answer. There's no perfect answer. A lot of times people will turn to their accountants or their CPAs or their bankers, and they may not have the depth of understanding. So I guess that's the first and foremost component.
The other thing I would add to that is I think people underestimate the importance of the relationship with the Nasdaq Analyst. So whatever professional you select to assist you through the uplist process, you want to make sure that they have a relationship with the analysts at Nasdaq. One of the things I've experienced recently is that Nasdaq is completely overwhelmed, and they have not hired more analysts. So if you're somebody that calls every single day, you're going to end up at the bottom of the pile. So it's good to have someone on your team that has a relationship, they know them by name, they have their direct line, and they can really help you. So I would just add that as
That's an
Completely
excellent.
agreed.
And while we're in Vegas, I think the odds are better than even money that at the end of the day, the amount of money you raise in the uplisting finance is going to be that number that you need to get on NASDAQ. It just seems to be.
All right. Yeah.
And Peter, after you do the situational analysis, who is the first person you hire or you look to or you advise the company to hire to continue the process? Is that a lawyer? Is that a banker? I mean, what's the process? Explain to everyone, sort of, they signed you up, you've done a situational analysis. What's step one on day two?
Part of that analysis is looking at your current team of professionals. And it is really one of the critical steps right up front is having the right attorney. Again, there are attorneys who have experience. My place of looking, and of course here working with Joe, is to go to those that know the process. And what separates Joe, why I would point to him first if anybody came to me, was he's experienced in the process, but he's proactive. There are just a lot of attorneys that are more reactive and act more, no pun here, and I don't mean to dig on attorneys, but are more scribes and are not really looking ahead towards what's coming and all the different components. So I would start with the attorney, and then obviously we would look at the banker as the next critical step. There's nobody better that I know than Mike. There are bankers that may be specific to an industry as well, so there's opportunities there to look at different bankers or to work as part of a team. The next piece that I think is also really critical, we haven't talked much about, is that you have two options available to you, NASDAQ and NYSE. And what we do is we urge our companies to talk to both. There are pros and cons. There are different industries that may be better suited. So whether it's talking to Paul Dorfman at NYSE or Andy Hall at NASDAQ, that's a really important part of looking at your team and making sure that you start off with a clear pathway and a clear strategy.
Right. And Peter, when we talk about bankers, because everyone here, there's a focus on raising capital in connection with an uplist. Organic uplists are very rare. I mean, we happen to have, I think there's maybe out of the 60, I think there were 68 uplist transactions completed in calendar year 2018. There might have been one or two organic uplists, meaning no capital raise, no reverse split. Before that, the year before, there might have been another one or two. We happen to, by luck, do two of them, which is shocking, right? Organic uplists, those we don't even count because they were, less hard. Let's put it that way. But let's talk about, the process of engaging the banker. And we're going to get to Michael. We're going to talk about the nitty gritty. But from what you do, and you advise companies, and on day 3, you're looking at engaging a banker. How do you do that? I mean, do you sort of firebomb their PowerPoint to 50 different bankers, or is there a better way? Because, we've seen, probably everything under the sun, and not all is effective.
Good point. Yeah, I mean, the exception of the rule is going to be organic uplisting, where they don't need additional capital to meet their shareholder equity requirements. The majority of the OTC companies are all going to need to raise capital. So for us, it's a selection process that's very organized. We don't think it's great to firebomb, but one of the value adds that we have is we can reach the bankers. For an OTC company to be able to get a hold of the right banker that might be the right fit for them can be difficult. Bankers are busy guys, right? They're not sitting around waiting for the phone call to come about an uplisting process.
Or returning a phone call.
Right.
No offense.
So
It definitely takes me 3 phone calls to return a phone call, but you guys are going to get return phone calls. It may take me a couple of days, but a cold call from an OTC client that wants to uplist and leaves the name and number, that's not going to be high on the priority list from live transactions to my prospects to you guys to returning calls.
That's why I love him, because he's just straight and direct and tells it like it is. It's not pulling any punches. And I think most companies don't realize that the banking selection, the way I would approach it, is that it's a roadshow for yourself. You want to know your banker. You want to pick that banker that you think is the right fit for your company, not just because they've raised their hand and said, we can raise you money. Unfortunately, because I've been an entrepreneur, I've been an officer and director of public companies, I took a company from zero onto Nasdaq. I've had many, many bankers make many promises that never happened along the way. You might be able to relate to 1 or 2 of those. So the selection process really also is then about qualifying the fit. It's got to be a match from both sides, because if not, you're not going to reach the desired outcome.
Yeah, and I would just say, from our perspective, if you hire the right consultant, not everybody needs a consultant, but if you hire the right consultant, they will open doors quicker than you could either do on your own or with hiring the wrong consultant. I do agree, and sometimes you aren't exactly quick on returning phone calls to us either, Michael, but we'll let that one slide. Quicker than normal. But no, I do think it is very important to hire the right group to get your banker set, because that is going to be the centerpiece, the cornerstone of the process. Because without the money, and we're going to get into the criteria in a second, but without the money, generally you're not going to meet the minimum requirements. So banker selection is extremely, extremely important.
And
Well,
I would just, I'm sorry.
Go ahead, please.
No, I was just going to add to that I'd had a case recently where, you're involved in this case actually, where there were 4 bankers that were pursued, that we went on with a roadshow, and 3 of them pursued the company, did an engagement letter, called them, was really eager, and the 4th banker we didn't hear from. And the CEO kept saying, well, I want to hear from the 4th banker. I want to hear, and I said, listen, if you're pushing this uphill already and you haven't even crossed the gate yet, you're never going to get this deal done. You have to go with a banker that's excited about your deal, that's calling you, that's engaged, and understands your space. So,
Did I get signed up on that transaction?
You were one of the ones that did call and were excited and sent the engagement. So,
Have they chosen a banker yet?
I will take this offline.
yes, of course. No, they are. They're choosing you. They are. Seriously.
Well, I think part of the banker, just to finish up my thought on it, is that you want bankers that can add value as well. And raising capital is critical. There's in an uplist, there is a lot of value add that can come from having the right banker. And so it's not just about raising the capital.
Right.
And that value add comes from experience. I mean, particularly when it comes to an uplist, this is a jigsaw puzzle. You have the NASDAQ requirements on one side, 3, 4, 5 is the only way I can remember them, right? 300 shareholders, $4 stock price, 5 million shareholders equity, market value, public float. You got to get there, and you have the existing cap structure of the issuer on this side. You got to figure out a way to put it together. And it's actually, there's a lot of creativity to the uplisting. This is as much an art as a science. So you need a banker that has done this multiple times before, because it's kind of not the same scientific exercise as a secondary.
Yeah, and Peter, before we move on to some of the technical requirements with Luisa, can you just discuss the costs associated, and then, does a bridge loan or a bridge financing make sense, and maybe the 2 types of bridges that we typically see, cost versus working capital?
Yeah, so typically, if you're going to look at a bridge, most people think, well, a bridge to where, a bridge to what? Here it's pretty simple. You're bridging going from the OTC markets onto a senior exchange. That's a very clear pathway and a clear bridge. So there'd be a bridge that I would consider as one that would be just giving you the capital that would be needed, doesn't take away from operations, but pays for some of the costs, which can add up to being able to afford the professionals, the application fee, and so on and so on. The other type of bridge that's out there, obviously, would be including of that plus operating capital. And there are some specialized groups that we know that will consider looking at bridges for the right conditions for that.
Yeah, and I will just say, if you are considering a bridge for your uplist, whether that's for the cost associated or for operating capital, have your banker involved in that process. Because we've been involved in transactions, we've seen times where, you know, the company goes out there and great, they can raise money, but they raise it on terrible terms, and then you tie the banker's hands, and it just kills the process. And generally, the banker can add value to that process if you've already selected a banker. So involve the banker in that bridge. Unless you're going to, you know, Aunt Sally, who's just going to give you, you know, pure equity, no resets, no warrants, no downside protection. Short of that, involve your banker.
So Joe and I did an uplisting about just over a year ago. Joe represented the company. I was a banker. Two things made this transaction particularly difficult, and that was the cap stack. I think they had series A, B, C, D, E, and maybe even F from all the different
I think it went up
finances.
to I, but that's...
So you had to flatten the cap stack, and all those series of preferreds came from different financings and bridges.
just
So-
makes everyone's jobs harder. So that is an important point. I know everybody wants to raise money. You don't want to turn down money, but involve your team, involve your bankers. Don't sign the documents, take the money, and then tell everyone. Just makes things a lot harder. Maybe, Peter, just before we move on to Luisa, if you can just maybe just talk about on day one, because from our perspective, you know, you have to do some house cleaning right away, right when you start this process. And you want to clean early and clean often, as we say. And I know you sort of help guide companies. Maybe you could just speak about that for 1 second.
It's a lot to clean up, typically in most OTC companies. Very rare to find one that's comes in all shiny and clean and ready to go for an uplisting. So that's part of what we do is roll up our sleeves. There are many different aspects of that. Could be legal components, could be balance sheet, could be officers and directors, could be corporate governance. There's no, you know, as you guys know, as entrepreneurs and professionals in the market, there's no one size fits all. So it's a very unique and kind of, you know, condition to the company itself. Time and cost are important to every entrepreneur. I like to tell people to expect roughly a 6-month process from start to finish as kind of a guideline. Could be shorter, maybe there's no registered offering, you know, could be longer if there is, or more cleanup to do.
Or longer if your banker doesn't return your call.
That is true.
Correct. But with the right team, I would say 6 months is a very reasonable time frame to give you some expectation. As far as cost, you know, I would turn some of that back to the panel here. You know, to get started is fairly easy. It's then about what is required. You know, let's take Nasdaq as a position. It's a $5,000 application fee. Total cost is $75,000. $5,000 is applied to that on the back end, but then you've got legal, and that can vary based upon the type of whether there's registration or the depth of the cleanup. Obviously, you know, bankers, but even considering Luisa, if the company has officers, that's not an additional cost. If you have to go out and recruit additional independent directors for the company, well, they have to be compensated. So it's not a simple answer.
And I would just say this is very important. There's 3 times of the year that you have to pay particular attention to the process. And I would say that they are the January, February timeframe, because everyone goes stale, at least your financials do, on Valentine's Day, right? Valentine's Day, February 14th. So everybody's trying to rush the price before February 14th. I would argue that July and August are very tough times to price anything or get anyone's attention. Nobody's returning any phone calls in August. And I would further submit that Thanksgiving is really the cutoff, although we have closed deals in December. So those 3, I wouldn't say blackout periods, but those 3 times of year you want to pay particular attention to the process and really start backwards. I mean, you should sit down with your lawyer or your professional as a quarterback and map out the process from beginning to end with time frames and agendas. I mean, one of the things we do is, you know, we sit down with a timetable map. We go through, okay, do you need a restructuring? Do you need a reverse split? How long does that take, et cetera, and sort of build it out to give you a tough time frame. And if one of those time frames fall on one of these blackout periods, well, you got to either adjust at the front end or adjust at the back end. That's very, very important. I would say so many companies and so many people ignore that process, and it comes back to bite them when they least expect it or least need it.
Great point.
So with that, maybe, Luisa, you can just take us quickly, because I think we ran a little bit over with Peter, but I think it was a good discussion, just about some of the general requirements that we talked about and some of the more important ways to achieve them,
Sure.
from the ground.
Yeah, so I'm going to spend another 3 seconds on the team. If you believe that you're going to be getting a new auditor or a new legal group, you should do it in the beginning of the 6-month process. The last thing you want to do is 30 days before financing an uplist, go get a new auditor and a new lawyer, because the lawyer's got to provide an opinion on your company, and the auditor's got to provide a comfort letter that they're comfortable with your financials. So that will completely delay your deal. So I would say number one is make sure you have your entire team in place before you hit the launch button. In terms of the minimum requirements, you need a $4 stock price after reverse split for either 30 or 60 consecutive days, depending on which criteria you're going for. One of the things I would advise companies is I've seen companies that their stock's at $3 or $3.20, and they say, well, I'll just go out and hire a bunch of stock promoters, and this, it'll be $4. That's the worst thing you can do, because Nasdaq is going to look to see if if you're promoting your stock, even if you're just promoting your press releases. If you're on these lists of social media or electronic email lists, and Nasdaq picks up that you've been promoting your stock, you're going to be you're not going to be able to uplist.
Yeah, the quiet period is really important. Everyone here should know that when you make the decision, when the board makes a decision, this is often very much overlooked, and we've had situations where we've had to have had battles with boards of directors and mainly CEOs about stock price. When you make the decision to go forward with an S1 registration statement for an uplist, you have technically entered the quiet period, or at least under the conservative approach to this process. So that means, you're not really going to be out there raising money except for pre-existing relationships and maybe board members, and you're not going to be out there promoting your company until the end of the process. So you have to really plan for a dry time. Right. Of no communication, no capital raising, and get through the entire process, 4 to 6 months, on your own. So that's why a bridge, and involving your banker early on is super important, because you wake up, you're halfway through the process, say, I run out of money and my stock price is down, I can't communicate. Very, very important.
The flip side of that is liquidity is one of the things that makes this process so much easier. If your stock trades, the pricing of the offer, the fundraising event itself will be that much easier. The pricing will be that much more beneficial to the issuer, and use of other things like warrants to get over some of the valuation issues will be less required.
Yep. Then the next item you need is 300 round lot investors, round lot meaning 100 shares. But the most important thing there is it has to be post-reverse. So more than one company has made the mistake of gone out, gotten their 300 investors, they each had 100 or 200 shares, then they did a 1 for 10 reverse, and all of a sudden all those shareholders have 10 shares. Yeah. So make sure you know exactly what you're doing in terms of your reverse before you
That happens a lot, by the way. Luisa is not joking. That does happen.
You'd be surprised.
Well, I think just to comment on that is that part of the strategy when that situation comes up is to work in conjunction with your banker to also have a retail offering.
Yeah.
Okay, so that's one of the easy ways to look at this to make sure you're doing it the right way.
And honestly, the quarterback, whoever that is, whether that's the lawyer like us when we're on transactions or somebody like Peter on transactions, you really should pull your transfer agent report and your NOBO list and all of your shareholders in CD & Co. and see what you have and run a situational analysis so you can make effective decisions on if you're going to do a reverse split, does that affect your shareholder base? So you don't run into those problems. Again, it's all about planning.
Yeah. The other one is $5 million of shareholders' equity at the end of the 12-month period after you uplist. So what that means is you're going to need to project for Nasdaq that, including all your operational expenses, all your legal fees, your attorney fees, all of those fees, your audit fees, your banking fees, all of those come out, and at the end of 12 months, you need to be able to show Nasdaq that you have a minimum of $5 million. And that's something a lot of people miss, is that they assume, I'm going to have $5 million at uplist, I'm all set. That's absolutely not the case. You have to show Nasdaq that you have at least 12 months and 1 day of complete cash runway.
Yeah, that's it. This one point right here that Luisa is talking about is probably the single most important point of this entire panel, because it can go sideways in numerous ways, not just with the 12 months and 1 day projection, but also with the net shareholder equity requirement of $5 million. You think you raise money, net of fees, you're at $5 million, but that's not where it stops. Luisa, maybe you want to describe sort of the burn rate analysis that Nasdaq does
Sure.
to reduce that. And we've had some problems with this calculation.
Yeah, absolutely. So the one that I just went through recently, they actually look at your actual cash burn. So they did allow me to add back in depreciation and amortization and also stock-based compensation. But they really want to see that at the end you have that sufficient cash. And it's interesting because I've had other Nasdaq analysts that did not allow me to add back in the depreciation and stock
So they really look at two
compensation.
things.
So-
They look at your cash going forward for 12 months and 1 day, and then you look at your shareholders' equity. Let's say it's $5 million, but then they take your net loss for the prior year. So if you're on a
Right.
year end, they take your net loss, divide by 12, and subtract that monthly amount for the amount of the current year. So for example, if you lost $1.2 million, they divide by 12, and they deduct $100,000 from your shareholders' equity for every month in that year until you achieve your uplisting. So you got to plan for not just that $5 million amount, but an amount for one, the burn rate calculation, which is a cash flow number, and two, the shareholders' equity calculation, which is really just the division of the net loss added back to your shareholders' equity. That is a super, super, super important point.
Yep. And then you need 15 million of public float, which is basically the total market cap of your company, subtracting out all the affiliates, like directors, officers, and 5% shareholders, and you have to have at least $15 million in value there. And then the last piece, and I'll talk quickly because I want to make sure Michael has time because this is very important, is the board of directors. You have to have a completely independent board of directors. This is going to be the most important decision you make, is the board that you select. You have to have an audit committee, a compensation committee. They have to be comprised of independent directors, and nominating committee, and a governance committee, and then you have to have certain policies in place that the board adopts, and all of that has to be in place before you can uplist.
Yeah, and I would just say, there's always a question, the interplay between, who's really independent? Do I have, is my buddy Johnny, who I grew up with, who, I haven't done business with, but has some experience in the industry, is he independent versus, an industry professional? A lot of CEOs and entrepreneurs they got to have independence, but they really don't want independence. They want independence to a degree, right? Because they're afraid to let go. I would say that it is extremely important to choose your directors wisely because Nasdaq will look, they don't look just at quantitative factors anymore. They look at qualitative factors. And I will tell you one thing that most boards overlook, technically the board is supposed to vote yearly, at least once yearly, maybe more, whether the other directors are independent. And that is getting extremely challenging for real independent directors to vote other independent directors independent in this regulatory environment. So you want to be very careful with your board selections. And one of the things I will just say that Luisa, Michael, and Peter all do, including us, is we make recommendations. There's certain industry professionals, certain people we've come across over the years that do serve on boards and can make a really big impact, with respect to the process in your company. I think, Michael, we should turn to you because you have a lot to say, and you're a very important topic here about financing and how do we go through this sort of financing process, in the jigsaw puzzle with respect to the uplist. And there's a lot of things we want to know about fees and minimum prices and how do you price.
So let's start with why it's so difficult and why it often becomes a little bit of an unpleasant process. So Luisa went through the capital requirements in Nasdaq, and from a mechanics perspective, this is really all about getting Nasdaq approval and what it's going to entail from a capital raise to ensure you get Nasdaq approval, right? So 3, 4, 5. We have 300 shareholders, $4 minimum bid price, $5 million shareholders' equity afterwards, plus the market value of the public vote. So here we are with Nasdaq requirements. But here we are with an OTC company, which kind of by definition is earlier stage, likely to have a history of losses, likely to have a lower stock price, right? They went public OTC some way or other, likely to have done patchwork quilt in the capital structure. So you're starting with kind of a little bit of a disorganized mess. Then you have your consultant, your banker in the middle, acting as quarterback, financial architect to get you to the promised land, which is on NASDAQ issue. So for example, the company we were talking about that had through I in series of preferreds out there that were counted as debt towards the capital structure. Well, you need to get all those converted over to impact your equity, so you have less negative equity, so you need to raise more money.
And you have a clean capital structure, because most of Michael's investors and other investors don't want to come into a company that have series of preferred with preferential rights when they're putting in straight equity per NASDAQ rules.
Right. The golden rule. He who has the gold makes the rule. No one new is coming in as junior to the capital structure.
So you really got to think about cleaning up your balance sheet. But Michael, can we talk just before we get to the question period, because Lulu's going to start waving at me in a second. Can we talk about pricing of a deal? You know, I don't think there's a topic that we don't hear more about, or we hear more about than pricing. You know, how do you price a deal as a banker? And we're not asking you for any trade secrets, but you know, everyone says, I'm going to do a reverse split. My stock's at $12. Well, we can price at 11. It's a great discount to market. That never happens. Never. I think I've done one uplist transaction we priced over the NASDAQ minimum. Maybe one. Maybe I'm misremembering it.
No, they all end up at the NASDAQ minimum with the amount of money. But let's kind of start with why, or where there's leverage, right? He who has the gold makes the rule. So if the company is illiquid, you have huge reluctance from investors to coming in. So the leverage swings to the investor front when there's not a lot of liquidity in the stock. When there is some liquidity in the stock, you have more of a true benchmark of value to price off of. And let's call a true secondary of a liquid stock that trades, it's called $100,000 a day. That's going to price at a 20 to 25% discount to the market. So if you're you're getting priced at a bare minimum of 25% discount. Plus, one of the ways that we get investors over the liquidity concern is by adding warrants to a unit. And I've done two warrants per unit. I've done 2 warrants per unit. I saw another deal that I'm so glad wasn't mine that needed 3 warrants per unit. So liquidity is a huge factor in minimizing the leverage to the institutions. But pricing comes from, and the reason pricing comes from not necessarily a true discount, is that the issuer doesn't really have a choice, right? Issuers invested 6 months, hundreds of thousands of dollars, is at the end of the road and needs the money to get there. So the gold is going to kind of take advantage of the company. No, they need this to get done. No, the minimum investment price per share is 4 whatever, then with a warrant it's 4 1/8, and that is generally why the pricing ends up where it's going to be. Now that kind of assumes you need institutional participation in an offering, which goes to how big the hole is, how much money you need to get on to NASDAQ. If it's a smaller amount of money, 3 million, 5 million type, you can do a retail type uplisting. And there are several firms, Dawson James in the room, that has some strength in retail placement of small deals. So if you need a few $1 million, you're going to do much better from a pricing perspective, because the retail investor doesn't really know. The banker tells the salesman tells the client, and the client pays.
We're gonna get cut off here in a second by Lulu. But Michael, can we talk about 2 more topics before we go to questions just quickly? Can you tell us about lockups? You know, lockups are a huge part of this process, and management and some of the insiders that aren't quite so inside resist. You know, why are lockups, meaning, you know, a restriction on the sale of securities from the insiders who've been with the company, right? Only the new investors get to sell for 6 months. Why do you need them? Why do you care? Why can't management do what they want? They're the ones who've been at this for 10 years, and now you're asking them to, you know,
so flip
stay on
it.
the sideline.
Flip it. I'm sitting here asking you for money, right? I'm an issuer. I'm asking you to write a check. But at the same time, I'm telling the investor that I may want to sell over the near term. Investor doesn't want you to sell over the near term. Investor wants to know that you are here for the longer term, not looking to exit it and looking to build the company. That's kind of philosophically. Practically speaking, I'm going back to liquidity and I'm going to be a broken record. If there's not a lot of liquidity in the stock, and if this is more of a re-IPO, investors are going to be fearful that management can sell big pieces and impact the stock price. Personally, I have different hot buttons. Lockups is one of my biggest hot buttons because, like you were telling the story, if one banker doesn't chase you, you should write them off, right? Yeah. To me, if management doesn't want to lock up going in, they're giving me all the wrong messages. Everything's wrong going in. So I got a couple of quick things. If management team can't tell me what the company does in 20, 30 minutes in a clear, somewhat concise place, I'm done, just because history tells me that that's a much harder financing. History tells me the management doesn't want to walk up, they're giving all the wrong signals to the market, and we're going to have trouble.
We have so much more to talk about. I wanted to get to fees and warrant exchanges and cashless exercises and other things, but I think, Lulu, you probably want to go to some questions before we have to break in about 5 minutes.
Let me hit one on fees.
Yeah, let's just do fees real quick, because everyone's probably, I'm still thinking about fees, Michael. Tell us about... Tell us about fees.
So,
what is market, really, for an uplist?
So we're meritocratic. We make money when we write tickets. You guys shouldn't be paying, no one should be paying monthly type financial advisory fees, monthly retainers. That should be immediately a red flag, because that says the banker wants to make money, has a stream of cash flow. What instead you want is incentivize your banker by a success fee so he can get the transaction done and move on to the next. So forget advisory fees. Retainers are important. Small retainers are very important, so the banker can give that retainer to the lawyer, so the lawyer can represent the underwriter.
Please pay your retainers.
Right. So a $25,000 type retainer that goes to underwriters' counsel is more than appropriate.
I think it's a perfect note to end on. Pay your lawyers. Lulu, do you want to go to questions for a few minutes?
You mentioned earlier quiet period. And I think, I just want to go over that a little bit more because I think there is a lot of confusion with companies. We see it when they come to us to want to do, stories in the magazine, et cetera. And then there's also what they're allowed to do. We talked about what they're not allowed to do, but I think I'd like to know what they are allowed to do. For instance, they can go to regular trade shows in their own business, correct? So I think if you go through what you can do during the quiet period, and also mention, excuse me, where social media comes into play around that as well.
Luisa, you want to
I'll start on the practical side, and you can give the legal talk. Basically, it's what's your normal course of business? If you, for the last 12 months, have consistently published with, Shelley's media outlet, and you've also been doing press releases, and you've been doing social media, then that's not a problem because it's normal course of business. What they don't want to see is all you did over the last 12 months is put out one press release a month, and now all of a sudden, 60 days before your financing, you're doing 3 press releases a week, you're on all these social media, you're on all sorts of public forums. I mean, that's the real world side.
So the real takeaway is when you're planning the process with your lawyer or your consultant, you're sitting down, you're doing this timetable from 9 months to 0, working backwards, that's a consideration. So if you start 9 months earlier, being communicative with the markets, with your investors, with shareholders, with the general world on social media, well then it's probably going to fly better than if you just started 60 days before your financing. I want to just say one other thing, because the quiet period just doesn't apply to communications, but also to financings. Once you make that decision, once that board votes to pursue the registration statement, if you're raising money, you have to be extremely careful about soliciting new investors. Now again, board members, existing investors, pre-existing relationships are all generally okay, although depending on the lawyer that you speak to, they'll have a different view. But remember, you have to get through that period of communication and financing with the ability to do none and say nothing.
Joe, I'd take it back to the beginning. I think those companies that realize they have 2 products, the one they sell and their stock, and they start day one by promoting, don't take that word
don't
in
use
a
that
negative sense, but you have a product and you have a stock, you got to address both from day one at a company, and then it becomes, as Luisa says, normal course.
One more aspect is that people overlook in a quiet period is the exchange is now looking at you as well.
Right, for sure.
And they do not take kindly to promotion and press
And the
releases
commission,
as
I will
part of
tell you, we
listing.
received comments from the SEC about communications. Because remember, this all goes back to the, Google Playboy gun jumping case of, years ago. That's sort of the most famous example of communications during a quiet period. You guys could look that up, but it was a very famous case. So the commission does as well. We received comments, about communications that we've had to explain.
I just want to, as negative as we can be, I mean, this works. Company Luisa's on the board of directors of. Last August, we did an uplisting for them. They wanted to raise $25 million at some valuation. We raised them $10 million, and nowhere near that valuation. We were realistic. They weren't. Okay?
I was realistic.
That was August 10th. We did a $10 million uplisting. It was a pretty good number. Well, since then, we've raised another $22.5 million. So for this OTC thinly traded company, we've raised $30 million over 9 months, covered them, benchmarks covered them from a research perspective, and each round has not only gotten easier from a mechanical point of view, it's gotten less dilutive from the company point of view, and much less conflictual in nature in terms of raising the money.
Any final questions?
As an investor, as a microcap investor, have you seen or do you know of any studies that show like an uplisting, like how it actually affects shareholder returns going forward?
I have not.
I have not either, but add the qualitative feature that if the company performs, and it's always about quality, it's always about company performance. If you are on Nasdaq, you're going to get that much bigger bang for your buck performing than if you were OTC.
Yeah, I think, generally, I think there's one last question in the back, Lulu. I think generally, our experience has been, and maybe it's just our companies and the companies we follow, a lot of times, in the short term, the companies have traded down, at least from the analysis we've done. The 68 that were done last year. I think one of my colleagues here, Jesse, who tracks these deals, I think a lot of them at least traded down initially, and when they get some firepower and some more strength behind them, they tend to do better. So if you're, as an investor, it's hit or miss, not every company, but,
And if I could just add quickly to that, I think one of the misnomers is you do a deal, let's say at $3.50, and you expect the stock to trade down to $3.50. Well, and then all of a sudden it trades down to $2.50, and you don't understand what happened. If you did the deal with a warrant, that institutional investor is flipping out of the stock, holding the warrant, and they're averaging the two in terms of the valuation on their books. So their actual valuation on their books of your deal is $2.50 or $2.60, depending on the calculation. So they don't just bring the stock to $3.50; they bring it all the way down to whatever that valuation is, and then it slowly will go back up.
That's an
as
excellent
you.
point.
What,
That's an excellent
yeah.
point. That's why, when you do a deal with warrants and you have to obviously do a little higher price deal because of NASDAQ minimums, you have to be really careful and really understand who's investing in your capital structure and work with your banker to understand who your lead investor is and what their investment strategy is.
Yeah, so yes, what's a banker cost? And a banker should cost, let's call it less than 10%. And I may even take some credit for creating the non-accountable expense allowance. I ran a retail brokerage firm, and you give a retail broker a percentage of the discount. Well, if you're paying a percentage of 8, 50%, you're paying out 4. If you're paying 50%, about 7, you're paying 3.5, and you're keeping the other in the house. Non-accountable expense allowance is simply another piece of the discount, just called something else.
One last question.
Joe, real quick, the impact on your cost of governance going from OTC to NASDAQ, just in a nutshell, because I think you guys have a lot of experience with that. Could you just a little more detail on that?
Sure,
Just like a side-by-side?
Sure, absolutely. And I think, Peter, you'll have some thoughts on this. And Luisa, of course. From a compliance standpoint for what we do on the legal side, we don't notice a tremendous difference. It's certainly higher. Our fees are higher. You have NASDAQ compliance. You have board meetings, committee meetings. So the stuff that we do, creating agendas, leading the board members, making sure they're being compliant is, does cost more, but I think the bigger cost is compensating the qualified board and giving the board the resources they need to do their job without just being a stagnant, independent, Nasdaq qualified for show board.
I completely agree. I think it's also a component of what exists currently with the company and the quality of the governance going in, and then obviously attracting the right directors and be able to maintain that is a critical piece.
My experience is that most early stage NASDAQ directors are paid between 50 and 80 a year, combined between stock and cash, in that range. So you got to multiply that by however number of independent directors you have,
Right.
That's worth every penny.
for the right ones, yeah.
Yeah.
True. Any other questions?
Well, the good news is, if you do have questions, I'm sure you're going to be at the cocktail party tonight.
Yes.
And you'll
We
be
will.
glad to answer them.
Thank you, everybody. We appreciate your time, and thank you again,
Thank
Shelley
you.
and Lulu.